Welcome to Nedbank Private Wealth's International Equity-Linked Note. This is a dollar-denominated S&P 500 index-linked autocall investment. This investment allows one to earn 9.7% return per annum in US dollars if the index has risen since inception on any annual call date. The performance is linked to the S&P 500 index and is for a maximum investment period of 5 years. It allows one to earn attractive returns, even if the S&P 500 index itself delivers only modest returns. The product also benefits from capital protection, which is underwritten by Nedbank Limited. It must be noted, though, that this protection is conditional on the index not falling by 30% at the end of the maximum investment period. The investment is best suited for investors looking for enhanced returns where they're currently invested in cash or bonds, as well as benefiting from the protection of their capital for market declines of up to 30% in dollars. The investment may not be suitable, though, for investors who need to have their capital protected under all market outcomes and who are unlikely to be able to remain invested for the maximum 5-year period. So what is an autocall event? An autocall event happens if the S&P 500 index closes at or above the initial index level. In other words, it has risen since the inception of the investment. An autocall event triggers the investment to mature and a capital plus snowball return of 9.7% per annum to be paid out. With that in mind, let's look at some payoff scenarios. If, after the first year, the index is higher than at the start of the investment, as demonstrated by scenario A, an autocall event will trigger the maturity of the investment. The autocall investor will receive a payout of 109.7% in US dollars, which is a 9.7% return on their investment. Scenario B shows the index being below the initial level on the first 2 anniversaries of the investment, but being positive on the 3rd annual observation date. This again triggers an autocall event, and in this scenario, the product matures at the end of the 3rd year, paying out 129.1%, which is 3 times the 9.7% snowball return. The reference to snowball return should now be obvious, since the 9.7% annual return is not lost for the years where the index is below the initial index level, but accumulates like a snowball rolling down a snow-covered hill in the cartoons. Scenario C demonstrates a situation where the maximum maturity date of 5 years is reached, with the S&P 500 index having never been above the initial index level on any annual observation date. In this scenario, the full amount invested is returned, since the investment is protected for a fall of up to 30% in the index. Even though the index did go below the barrier level of 70% of initial index during the 3rd year, the index level in relation to the barrier is only relevant at the end of the 5th year, so only relevant if the product has not been called on any of the first 4 annual observation dates. If, however, no autocall events have occurred during the 5-year period, and the index is below the barrier level on the 5th anniversary of the index, then the conditional capital protection falls away, and the return will be the same as if the investor had invested directly in the S&P 500 index. Finally, scenario E shows a situation where the first annual observation dates on which the index is positive is the 5th and final observation date. In this scenario, the payoff is 148.5%, which is a 48.5% return in US dollars on the dollar amount originally invested. We backtested this product over the past 25 years, from the 1st of June 1995 to the 30th of June 2020. This was before the Springboks had even won one of their Rugby World Cups. Over this 25-year period, the product would have been auto-called at the end of year 1 75% of the time, and in 89% of the time, an autocall event would have occurred over the 5-year period. In only 11% of the times was an autocall event not occurring over the 5-year period. And it's important to note that even in these 551 observations, being 11% of the time, in no cases was any capital lost, since the barrier of 30% down was never breached over this 25-year period. Here is a summary of investment. This is for a maximum term of 5 years. The underlying index is the S&P 500 index, and the investment is dollar denominated. Minimum investments are $10,000. And capital protection is in US dollars and against a fall in the index of up to 30%. The indicative annual return is 9.7% per annum, giving a maximum potential return of 48.5% in US dollars. It must be noted that the annual return and maximum return are indicative and net of all fees. They will be determined on the trade date based on the prevailing market conditions. Call dates are on each annual anniversary of the investment. The maturity barrier level is 70%, and this is monitored only at maturity, being the 5th anniversary. Fees included in the product include a product advisor fee, which is 50 basis points per annum.